Tensions in the Middle East spark major market shifts while the AI stock rally faces a crucial test. In other news, semiconductor stocks surge and Fed policy remains a hot topic. Here are today's top 10 stories you need to know. Recent discussions around tariffs and trade policy have resurfaced as significant contributors to inflation concerns. Analysts are closely monitoring how these policies could affect import prices and ultimately consumer costs. The market has begun to react sensitively to any news related to trade, as the potential for increased tariffs could lead to higher prices for goods. This inflationary pressure may impact consumer spending and overall economic growth. The possibility of tariffs complicating the inflation narrative has caught the attention of both investors and policymakers. Expectations are building that any new tariffs could hinder the recent economic recovery seen in various sectors. Analysts suggest that the impact of tariffs on inflation will depend on how aggressively they are implemented. As trade discussions progress, market participants will be watching closely for any signs of escalation. The outcome of these negotiations could have lasting effects on the economy and the stock market. Moving forward, we can expect further developments in trade policy to shape economic indicators and market reactions. As the earnings season unfolds, a mixed set of signals is emerging from major companies. While some, like Apple and Meta, have reported strong earnings, others like Amazon are facing scrutiny over future guidance. This divergence in performance is shaping investor sentiment and market dynamics. Companies that beat revenue estimates are being rewarded, while those that fall short on guidance are seeing stock declines. This trend indicates that the market is becoming increasingly selective. Investors are focusing not just on earnings beats, but also on future growth potential and margins. The mixed results highlight a broader uncertainty in the market, suggesting that the economic landscape remains fragile. High-growth sectors are particularly sensitive to shifts in guidance, leading to increased volatility. Analysts are advising caution as earnings reports continue to roll in. They emphasize the importance of assessing not just current performance, but future expectations. As companies prepare for the next quarter, their guidance will be critical in shaping market outlooks and investor strategies. The Federal Reserve's policy direction is back in the spotlight, as recent comments from officials indicate a potential shift in approach. Some Fed members have hinted at the necessity of a rate hike, while others suggest a cautious stance. The mixed signals are creating uncertainty in the markets as investors try to gauge the Fed's next move. Recent labor market data has shown signs of deterioration, which complicates the Fed's decision-making process. The potential for inflation to remain elevated due to rising oil prices adds another layer of complexity. Market participants are closely watching inflation reports and employment data to anticipate the Fed's future actions. If inflation continues to rise, the Fed may be forced to adopt a more hawkish stance. Conversely, easing inflation could allow for more accommodative policies. This delicate balance will be crucial in shaping market sentiment and investment strategies. Going forward, the Fed's decisions will be pivotal in determining the direction of interest rates and overall economic stability. The once unstoppable rally in AI stocks is now encountering significant headwinds as investors reassess their positions. After a period of rapid growth, many are taking profits, leading to a shift in market dynamics. Analysts suggest that the AI sector is undergoing a momentum consolidation phase. This means that while some leading stocks remain strong, broader participation is narrowing. Investors are becoming more selective, focusing on companies with solid earnings growth. This trend indicates a shift from a focus on valuation expansion to a preference for tangible results. The AI sector remains critical for the overall market, but its future performance will depend on individual company results rather than a collective rally. As earnings reports roll in, market reactions will be closely tied to guidance and performance metrics. Moving forward, the AI sector will need to demonstrate its resilience and adaptability to maintain investor interest and confidence. Semiconductor stocks are experiencing a significant rally, driven by positive forecasts from major industry players. Companies like Micron and Qualcomm are leading this surge, which is vital for the overall market's performance. Semiconductors have been a key driver of growth in recent years, and their success is often seen as a barometer for the tech sector. The current rally indicates strong demand for AI-capable chips and data center investments. Technical analysts suggest that as long as the semiconductor sector remains strong, it can provide support for broader equity markets. However, rising interest rates or economic shocks could jeopardize this growth. Investors are advised to keep a close eye on semiconductor earnings as they could significantly impact market sentiment. The outlook for the semiconductor industry remains optimistic, contingent on continued demand and innovation. As the year progresses, any shifts in demand or technological advancements will be crucial in determining the sector's trajectory. Renewed geopolitical tensions, particularly between the US and Iran, are significantly influencing global markets. Recent military strikes in the region and subsequent surges in oil prices have led to a repricing of risk across multiple asset classes. Historically, conflicts in the Middle East have triggered volatility, and analysts are noting a clear pattern. As oil prices rise, tech stocks often face downward pressure, while defensive sectors, such as utilities and consumer staples, strengthen. This shift indicates a rotation within the market, favoring energy and defense stocks over more volatile growth sectors. Investors are closely monitoring developments in the Middle East, as sustained tensions could lead to further economic repercussions, including supply chain disruptions. The current market environment suggests that if these tensions persist, we can expect continued strength in defensive sectors, while growth stocks may struggle to regain momentum. The implications for global economies could be profound, affecting inflation rates and consumer confidence. As the situation evolves, investors should prepare for potential volatility and consider rebalancing their portfolios accordingly. The tech sector is increasingly feeling the pressure from earnings guidance, as recent trends show that mere earnings beats are no longer enough to satisfy investors. Companies like Amazon have reported strong results, but experienced stock declines due to concerns over future growth potential. This shift illustrates a growing preference among investors for clarity on forward margins and growth trajectories. As the market approaches a critical resistance point, analysts suggest that stock performance will become more sensitive to guidance. Companies with clear growth visibility are likely to outperform, while those that fail to provide convincing forecasts may struggle. This evolving landscape indicates a more discerning investment environment, especially within the tech sector. As earnings season progresses, the focus will remain on how companies manage expectations and navigate market challenges. Going forward, investors will need to assess not only current performance, but also the strategic outlook provided by tech firms in their earnings reports. The escalating tensions between the United States and Iran are creating significant volatility in global markets. Recent military actions, including airstrikes and naval maneuvers, have prompted a reassessment of risk by investors, leading to heightened uncertainty. The U.S. has imposed new sanctions, further straining diplomatic relations and fueling fears of conflict. As a direct consequence of these heightened tensions, oil prices have surged, with Brent crude reaching levels not seen in years, which is impacting inflation and economic forecasts worldwide. The market is experiencing a notable rotation away from growth stocks, particularly in the tech sector, towards more stable industries such as energy and defense. This shift illustrates a growing wariness among investors regarding geopolitical risks that could disrupt global supply chains. Analysts predict that if tensions remain high, we can expect continued fluctuations in market sentiment and asset prices. The implications for global economies are extensive, potentially affecting consumer confidence and spending patterns. As these geopolitical developments unfold, investors will need to remain agile, as the trajectory of oil prices and market stability hinges on diplomatic resolutions or further escalations in the region. The AI and semiconductor sectors are becoming pivotal in shaping market trends as they demonstrate strong growth potential. Recent data indicates that companies like Micron and Qualcomm are leading the charge, igniting a rally in AI chip stocks. This momentum is crucial as semiconductors have become the backbone of technological advancement in recent years. The global push towards AI integration across various industries has amplified the demand for advanced semiconductors, which are essential for processing vast amounts of data efficiently. Investors are closely monitoring these stocks as indicators of broader market health, as their performance often reflects overall economic conditions. The relationship between semiconductor performance and market momentum is well established. Robust growth in these sectors can drive investor confidence. However, analysts caution that this support could be jeopardized by rising interest rates or unforeseen economic disruptions. Despite these challenges, the outlook for the semiconductor sector remains optimistic, provided it can sustain its innovative edge. As companies continue to invest in research and development, the market will keep a keen eye on upcoming earnings reports from these key players, as they will be instrumental in determining the trajectory of this vital sector in the coming months. In a significant development, escalating geopolitical tensions, particularly those between the United States and Iran, are driving major shifts in global markets. Recent military strikes have heightened fears of conflict, while rising oil prices have prompted a rapid reevaluation of risk among investors. This environment of uncertainty has led to a noticeable rotation away from high-growth sectors like technology, which have dominated the market in recent years. Instead, defensive sectors such as energy and healthcare are witnessing increased interest as investors prioritize stability over aggressive growth. The impact of these geopolitical events is being felt across various asset classes, with oil prices surging to levels not seen in months and market volatility increasing sharply. Analysts suggest that if these tensions persist, we can expect continued strength in defensive stocks, while growth sectors may face ongoing pressure. The implications for the broader economy could be profound, potentially affecting inflation rates, consumer confidence, and spending patterns. As the situation unfolds, market participants will need to stay alert and adaptable to navigate this challenging landscape. The next few weeks will be crucial in determining how these geopolitical factors will shape future market conditions, particularly if new developments arise that could further escalate tensions or stabilize the region. Thank you for joining us for today's news recap. Which story shocked you the most? Don't forget to like and subscribe for more updates.